Becoming a consistent trader requires a combination of discipline, knowledge, and experience. Here's an example of how to make the right choices and become a consistent trader. Develop a solid trading plan. Start by developing a well-defined trading plan that outlines your trading strategies, risk management, and trading goals. For example, you might decide to focus on trading in a particular market, such as forex, and use technical analysis to identify trading opportunities. Practice risk management. Implement risk management strategies, such as using stop-loss orders and position sizing, to help you manage your risk and avoid large losses. For example, you might decide to set a stop-loss order at 2% of your account balance for each trade. Keep a trading journal. Keep a trading journal to record your trades, including the entry and exit points, the rationale behind your decisions, and your emotions during the trade. Use your journal to analyze your trading performance and identify areas for improvement. Manage your emotions. Emotions such as fear, greed, and impatience can lead to poor trading decisions. Learn to manage your emotions by sticking to your trading plan and using mindfulness techniques, such as deep breathing or meditation. Keep learning. Markets are constantly changing, and there's always something new to learn about trading. Stay informed by reading trading blogs, attending webinars, or taking courses to improve your skills and keep up with market trends. For example, let's say you're a forex trader who focuses on technical analysis. You've developed a trading plan that involves using moving averages and other technical indicators to identify trading opportunities. You've also set a stop-loss order at 2% of your account balance for each trade and keep a trading journal to track your performance. One day, you notice a trading opportunity where the currency pair you're interested in is approaching a key support level. You analyze the chart and decide to enter a long position, using a moving average crossover as confirmation. As the trade progresses, you notice that the currency pair is starting to move against you. However, you stick to your trading plan and decide to wait for your stop-loss order to be hit. You resist the temptation to move your stop-loss order or exit the trade early. Eventually, your stop-loss order is hit, and you exit the trade with a small loss. You record the trade in your trading journal and analyze your performance, identifying areas where you could improve your strategy. By following these steps, you can become a consistent trader and make the right choices that lead to profitable trading.